Welcome to Ben's Market Insights. So this week we're going to talk about the inflation numbers that the Fed looks at in the US. We're going to talk about the rate setting committee meeting tomorrow, again at the Fed, and what they're likely to do. But quite interesting, we're going to spend a little bit of time on the micro-analysis, which is really around trying to think about what the results look like this week for 4 of the 7 MAG4 companies in terms of their earnings discussion and outlook and guidance. And then we've also spotted a potential opportunity in the credit scoring segment of the investment world, which includes companies like Equifax, TransUnion, Experian. If you like this content and you want to see more, then please give us a thumbs up and subscribe on our YouTube channel and also onto our various podcast offerings, and sign up to our email as well. Thank you very much for that. So let's jump in. So the PCE, which is the core inflation number that the Fed likes to look at, has been stuck around sort of the 2.7 to 2.8% mark. That's not going to frighten the Fed in any shape or form in terms of the likely decision on interest rates. Now, having said in the last couple of weeks that we think interest rates are heading lower, I suspect that when we see and hear tomorrow from the committee, rates are probably going to stay stable. And I think that that's more with a view that the chair and the committee are thinking, well, you know, with new members coming on board that are going to be more Trump supporting, those rate declines are going to be coming anyway. So let's do nothing for now, because later down the line in the next 2 to 3 months, we're going to see certainly lower rates than the 3.75% we've got currently. Whether it's justified or not is another matter. I suspect to a large extent it's going to be expansionary and and will create some form of overheating in the economy. Let's go into micro. So we've got Microsoft, Tesla, and Meta reporting tomorrow after the close. And then we've got the day after Apple reporting after the close. I think overall the shape of the performance to this date in terms of all of those names has been encouraging. We've seen a little bit of up performance most recently, but pretty much most of Q4, the MAG4 have underperformed the broader market. And that is a good, I think, setup into the earnings results at this juncture. With most of them, I think, relatively cheap versus growth against the market, apart from Tesla and Apple on this occasion. So it's really sort of Microsoft, probably the slightly more expensive, but certainly Meta and Google, when they report next week, are the most attractive from a valuation perspective. All benefit from what has been a very weak US dollar so far this year, which has resulted in all sorts of other things going on, like gold and silver moving much higher, as we have said in our previous allocation strategy discussions over the last couple of weeks. Please go back and take a look at those. And of course, lower rates as well are encouraging to these technology plays as well. So when we take each one at a time, I think the data center market is proving to continue to be in growth mode. So when you look at Microsoft, which is going to be announcing, we should see some decent numbers coming through from them. And I'm taking that cue from TSMC, which reported last week, which suggested a strong demand for data center chips. I think that in case of Meta, whilst Llama, its AI offering, has been, shall we say, lame, nonetheless, the ability for Meta to use large language models and AI to target their customer base on behalf of their brand customers is getting better and better. That means better margin for Meta and better outcomes for their customers, i.e. clients and brands. So I think that they'll actually also produce some decent guidance going forward. I've never really liked Tesla because it's a very expensive stock and certainly more valuable than the entire US and European motor companies. But I think that there is an upside here from the perspective that more and more of the discussion will be around the Robotaxi offering. That looks like, in terms of the cost, coming through at a significantly lower cost as an offering to the marketplace than Waymo or any other player right now. So they are ahead of the curve in Robotaxi, and I think they'll probably concentrate a lot of their discussion on the promise rather than the actual, which is that the car sales have been certainly overshadowed by BYD, which is now the world's biggest EV seller. Tomorrow, Apple, again, I think it's an expensive stock as a hardware provider. Yes, services are growing. Yes, the replacement cycle is at a critical juncture, and I suspect that they'll have some good guidance around that replacement cycle and the latest iPhone sales and service offering. So overall, I think that we're actually in a position to see some decent guidance coming from these MAG7. And of course, I think for the market to continue to grow and develop, overall, the MAG7 have got to take some of that slack, if you like. So moving swiftly on to an interesting opportunity that I think I sort of spotted out there. We've seen weakness in the likes of Equifax and TransUnion in the US over the last year. Equifax is down some 15% in 2025. Experian was some 2.5% down last year, but has taken a big hit this year so far, down almost 20%. And the reasoning has not been its results, but more, which has been pretty much in line, growth at around high teens, EBIT margins for all three at around sort of the 30% mark. Multiples not excessive, certainly in the case of Experian, around 12 to 14 times forward earnings. They have a March year end, so I'm looking at March 28 as the forward earnings multiple, with 15 odd % type of earnings growth. So very reasonable valuation. But why the weakness? So generally speaking, the market believes that AI is going to replace these credit scoring companies with a strong LLM, large learning model platform that is able to pick out all of the relevant data for consumers to be able to use. I suspect on this occasion, the market has actually got this wrong. And I'll tell you why I think that's the case. Certainly, when you look at the data, and one of the key structural themes that we look at is around big data and who owns that data. And in the case of the credit scoring companies, most of that data, the vast majority of that data, is proprietary. And if it's not proprietary, it's been built over many, many years with combinations of relationships with third parties that are essentially closed or walled garden type of data that is not available in the general marketplace, and therefore these large language models have no access to this kind of data information. And so it's very unlikely that AI can replace or displace the credit scoring companies. Certainly when you look at what access AI has got in this space, well, it doesn't have access to personal identifiable info, which is PII. That is something that sits very much in the heart of big data that these credit scoring companies have, including credit reports on individuals and corporates. LLMs cannot access proprietary data and third-party data, as we said, because that's very much contracts within the walled garden. There is no access to confidential business data either. That's directly accessible between the credit scoring companies and the corporates. And all the sensitive market attributes that AI could find are not available, again, as a function of what these credit scoring companies are able to generate. So on this occasion, the market and investors have got the wrong end of the stick, I think, in as much as these companies' big data is very proprietary and walled within an encrypted, highly encrypted environment, which is part of the whole GDPR, private confidentiality elements. And so there is very little opportunity for displacement. I think the credit scoring companies will continue to do well. I think that these are actually cycle agnostic, because in bad markets you need to have a good credit scoring environment to understand what your competitors and peer group is doing. And in good markets, when there's lots of transactions, again, understanding the peer group credit score is an incredibly important part for both consumers and corporates. So here's an opportunity. Some of these stocks are very weak. Maybe it's worth a look. So we're going to comment next week on the big numbers that are going to come through, both from what we've seen this week in the MAG4, plus Google and Amazon reporting next week. And more of that next week. See you soon.